Good afternoon, everyone. Welcome to the 2017 Civil and Environmental Engineering Fall Distinguished Lecture. I'm Jack Maley. I'm a member of the Civil and Environmental Engineering faculty. And I have the great privilege of being able to introduce this year's distinguished lecturer, my friend Janiele Maffei. And in case you didn't know, Janelle is an alumna of UC Berkeley. She earned her AB in architecture in 1978 and then followed up with her master's degree in structural engineering in 1980. In fact, you were just going out the door when I was coming in the door. Okay, we didn't meet until a few years later. Anyway, following graduation, in addition to raising a young family, Janelle had a rather diverse work experience with many different companies, some very well-known ones, Black & Veatch, Reed & Terex, Farrell Elsesser, and Degenkolb engineers, including some self-employment along the way as well. Her position at Degenkolb extended over roughly 14 years, during which time she worked as a project manager and regional office director. I think you were in the Oakland office at the time. During that period, the Northridge earthquake occurred, and Janelle spent 18 months working on single-family residential damage, which became really a defining topic of her career going forward. After the Degenkolb years, Janelle opened her own practice, Janiele Maffei Structural Engineering, with a commitment to bringing earthquake engineering to homeowners. And one day, she says, about 6 years ago, a dream job description announcement crossed her desk, and she realized her work was not yet over. And she took a new position as the California Earthquake Authority Chief Mitigation Officer. And in her new job, she is responsible for developing policies, plans, and incentives for retrofitting wood residential construction throughout California to mitigate the consequences of a major earthquake in the state. Along the way, Janelle has had several important professional leadership positions. I'll notice a couple of those here. She was on the board of directors for SEONC, Structural Engineers Association of Northern California, and the board of directors secretary, and I think still treasurer for the Earthquake Engineering Research Institute with its headquarters in Oakland. Janelle has also found a few occasions to return to the UC Berkeley campus. In her professional practice, she had the responsibility for managing several major building projects on the campus, including the seismic retrofits of Doe Library and LeConte Hall. She currently serves as a member of the advisory council for the department. In recognition of her many contributions in 2016, she was inducted into the Civil and Environmental Engineering Academy of Distinguished Alumni, a big honor. And today we're delighted to welcome her back to campus again to deliver the 2017 CEE Fall Distinguished Lecture. Please join me in welcoming Cal alumna Janiele Maffei.
Well, thank you. It is really a privilege and a pleasure to be here, and thank you to all of you for coming. This is really exciting to come here and share with you what I'm doing. This was, as Jack mentioned, this was like a second career. I was a consulting engineer for many, many years, and then this opportunity landed on my desk, and it has been an amazing ride these last 6 years. In my title, I wanted to include the diversity of topics that I've had to learn and to deal with. Now, not always actually having to do them myself. In fact, my current job, I'm really the client, which I will tell you, I much prefer to being the consultant. When I leave the meetings, there's always some brilliant engineer or social scientist or financial person who's going to go off and do the work. And it's just really been amazing to work with them. But I want to go back to the beginning and embarrass my husband. So this is me in the front, and right behind me is my husband, Rob Tavani, who's sitting down here. That's 1980. So obviously we look pretty young. And then, off we go into the work field, and with these really exciting careers in structural engineering consulting. But to talk about the CEA, and I do want to tell you about the California Earthquake Authority that I'll refer to as the CEA, I need to go back to the 80s. The CEA was created in 1996, but to go back in the 80s because there were a series of earthquakes. The 1971 San Fernando Valley earthquake, and then this Coalinga 1983. And earthquake insurance was an industry very much in flux. Modeling so that they could understand their expected losses was really in its infancy. And a number of earthquakes came along, and so the state of California passed a law in 1984 that created a very important piece of what is residential earthquake insurance in California called the mandatory offer law. So earthquake insurance was specifically removed from the homeowner's policy, made a separate policy, and if you wrote a homeowner's policy in the state of California, you had to offer earthquake insurance. So you must notify, and offer is a little bit of a strong word, let's be very clear. Insurers had to notify their policyholders that earthquake coverage was not included in their homeowner's policy. Insurers must offer earthquake insurance in writing. So every 2 years, a homeowner would get a letter that said, this is how much your earthquake insurance is. They must describe what this policy, and at the time it was called a mini policy, was, which is the coverage, the deductible, and the premium. And then it must meet this particular standard. So there was kind of a bottom standard for earthquake insurance. And a lot of this is going to sound very familiar because we are dealing with health insurance right now on a federal level. Earthquake insurance is actually managed on a state-by-state level, and there's certain pieces that the federal government plays in that, but predominantly it's on a state level. And so this is the state of California's policy, was the earthquake insurance policy is separate, but the homeowners insurers that write in California must offer the policy. And the insured, once they received the offer, had 30 days from the date of mailing to accept the offer. And then along came the Northridge earthquake. At the time, almost half of California homeowners had earthquake insurance. The Northridge earthquake hit 6.6. It happened in the San Fernando Valley, very residential area, and it was catastrophic. And with half of the area insured, particularly multifamily, it was devastating to the earthquake insurance industry. Property damage was about $40 billion. And the aftermath of that was that most insurance companies stopped writing. And the reason was $20 billion was half of the damage was in residential construction. This is both single family and multifamily, which would be apartments and condominiums. And so the insured were faced with a $10 billion loss. They had not anticipated this. They had not charged premiums that would create enough capital to cover this. And they were going to stop writing insurance, not just earthquake insurance, but because of that law, that mandatory offer law, we're going to stop writing insurance entirely. Now, in California, as in most states, if you get a mortgage, you are required to get a fire insurance policy. And then, of course, once that fire insurance policy kicks in, there's that earthquake mandatory offer. So they just stopped writing policies. So not only an insurance catastrophe, but a banking and mortgage catastrophe. So along came the California Earthquake Authority, the CEA, created by the California legislators. It is a not-for-profit instrumentality of the state. I don't believe that there's any other entity in California that can call itself a not-for-profit instrumentality of the state. And it's very important that it's called an instrumentality and not an agency for a number of reasons I'll show you. Our strategic plan is to educate, mitigate, and insure. And educate, you need to make sure that California homeowners understand their risk in order for them to take any action, including perhaps an insurance action. Mitigate, which is really where I come in, because the idea is to not only transfer risk, which is what insurance is, but to mitigate risk, to reduce risk. And then insure. Of course, the core reason for the CEA is to insure. The CEA is privately financed, which is very unusual, not part of the state budget, and publicly managed. So when I say privately financed, let me explain this to you. When they were created in 1996 by the legislature, They had 13 participating insurers that came in and all brought part of $1 billion worth of capital. And it was based on the number of policies they brought in, or pardon me, the amount of risk that they brought in. So if you had more expensive homes, you're bringing in more risk. We currently have just under 22 participating insurers. So the California Earthquake Authority would not sell you an insurance policy. Actually, if you have your homeowners, let's say with State Farm, as we do, State Farm would actually offer you the CEA's insurance policy. And in the event of an earthquake, if you have a claim, it will be your homeowner's policy company that will adjust your claim, come out and look at the kind of damage and determine how much money you should get for that. So we are like one step removed from people who have the insurance, but we manage the fund, we manage the risk, and essentially write the policy. So privately financed was the money came from the participating insurers, and then as the organization grew, the money came from premiums from its policyholders. And you can see in 2006, we were roughly at 755,000 policyholders. We've grown steadily, and then there's some really exciting things that have happened in last year and this year that have really made it go off the charts. On average, between 2006 and 2015, we would gain about 7,200 policies a year. In 2016, we gained 52,000, and we're on track to do even more than that this year for very good reasons. One of the things that people have always said about earthquake insurance, and frankly that I thought, until I really joined the CEA and looked into it, was that there wasn't enough financial capability to cover all losses. And one of the reasons is when that mandatory offer came every 2 years, it was in block letters, it was all legal, it certainly wasn't a marketing document by any stretch, told you how much your premium was and what you would get for that policy. But it also said you may not get all of your claim paid in the event of a very large event. And of course, people immediately would read that as, you know, these guys don't have the financial strength to really back us after an event. But what it really meant was, and if you look at this is a tower of financing, and you start from the bottom, we have just under $6 billion worth of capital. That's cash. We have reinsurance, which is insurance for insurance companies, revenue bonds, which are CAT bonds, or catastrophe bonds, which is debt. And then all of those participating insurers have a little bit of a layer of liability in the event of a very, very large event or a number of events. We start from the bottom and go up. And you can see on the right-hand side there what our losses would be, what we would expect to have in losses if the 1989 Loma Prieta, 1994 Northridge, and 1906 San Francisco earthquake happened again. So you can see that we could have 2 Northridges and we would still have sufficient capital on hand to pay claims. So the idea is that we actually have quite a bit of financial backing. However, if there was, you know, the Dwayne Johnson kind of an earthquake, you know, that was so outrageously high, the idea would be that within, I think it's 7 days, we have to report to the Department of Insurance what our expected losses are, so that from day one, if we have to prorate our payments, it will start right from the beginning. But of course, an insured, you know, let's say that we can only pay 98% of our claims. That insured is getting 98 cents on the dollar, but of course, anyone who is not insured is, of course, absorbing all of that catastrophic earthquake. Now, I was one of the people, if people said, should I get earthquake insurance as a structural engineer? I always said, you need to mitigate first. And don't tell my boss or my colleagues, but I probably would still say that to you. But the reality is that I've significantly changed my opinion on earthquake insurance. And I don't want to convince you. I'd like to say that if you're interested in learning about it, that you learn for yourself that it's changed. And so in 2016, we made significant changes. And they're all available for you to understand on our website. And it's a premium estimator. And so you go in and you put in your first of all, you pick which one of the insured you are. Are you a homeowner, a renter? Do you have a condo unit or a mobile home? And when you go in, you put in your zip code, so that's location. You put in a couple of features of your home, including what it's insured for. And then you can play with the various deductibles and the various coverages so that you understand what your premium is. And there's a fantastic little dial up at the top that will literally change with your choices. And so you'll have a chance to see exactly what a home in the Bay Area would cost to insure. And for those of you who aren't owners, if you want to play with it, go on Zillow, pick a house, and then go on and play with the quote. And for those of us who perhaps have gotten those letters every 2 years and looked at that premium and thought, whoa, and a 15% deductible, it really is a new day at the CEA. And so there's my kind of like last pitch for re-looking at earthquake insurance. The important thing, though, that a lot of people make a mistake with is that the insurance is not based on the sale price or the expected sale price of your home, but rather on the replacement cost. And so it's the same value that your house is insured for fire insurance. And so a lot of people will go, well, look, I just had my house on the market for $1.5 million, and so the premium will be, and the idea is that, yes, it's high, the replacement cost is high, but it is not the sale price. And so that's an important thing. The other mistake that people make is that they think of a deductible as what they need to come out of pocket with. If you have a 10% deductible, I'm going to need to write a check for 10% of the replacement cost of my house. The reality is that's a financial trigger. So you don't have to pay that, you don't have to put that money into your home, but rather a trigger such that that is what you are self-insuring for, and what's above that is what you would receive in your claim payment. So those two things are very important. So once again, replacement cost is what you are insuring for, not the sale price of the house. So publicly managed. I said we're an instrumentality of the state. We're not an agency, but we are managed publicly. And in fact, our board includes the governor, the insurance commissioner, and the treasurer of the state of California. Now, we've never met Jerry Brown. Dave Jones and John Chang have both come to meetings. In fact, Dave Jones, as insurance commissioner, is very, very involved. We actually have designees who come and sit on our board. But those designees are, in fact, representing these 3 elected bodies, and then 2 non-voting members that represent the Assembly and the State Senate. So publicly managed. And we're not an agency, but because of our public management, we operate under some of the same rules that an agency would. For example, our meetings have to be publicly noticed. We can't hold private board meetings with our board. They have to be held in public. If I want to hire a consultant, I have open procurement where I have to do either an RFQ, RFP, request for proposal, where I put out the request for people to tell me their qualifications, and we have to do a public evaluation process. So there's a lot of things that we do that are similar to an agency. We also have a number of employees. In fact, soon to be almost all of our employees are state employees. So they don't work for the state, they're civil service employees that work for this instrumentality, just to make things nice and confusing. So like an agency, but with none of the protections of an agency and none of the restrictions as well. And one of the good things is that our budget is separate from the state budget. And very careful, like an engineer, to say not to scale down here. California budget is $183 billion, the CEA's budget, so what we use to manage that risk pool, about $34 million. When I joined the CEA 6 years ago, the loss mitigation fund that I'll explain to you was at about $25 million. So the nice thing is, you have a bad year in California, the state can't dip into that capital that I showed you in the tower. We are separate from them. So the CEA budget. How do I do the work I do as chief mitigation officer? Since they were created in '96, 5% of investment income up to $5 million is put into a loss mitigation fund. Investment income is you take that capital and you invest it conservatively, and 5% of that up to $5 million. There was a time actually when we would get $5 million since 2008, so a little bit less than that. That's what's gone into a loss mitigation fund. Now, this loss mitigation fund is intended for all Californians. So we have a mission to do something for all Californians, not just policyholders. And it's one of the reasons that we have this outward-facing, all California responsibility is that with it came a federal tax exemption for the premiums that we collect. So instead of paying taxes to the state and the federal government, that money goes back into capital. And so the idea was here that you have some public-facing mission and you get this tax exemption which benefits all policyholders by doing some mitigation for all Californians. So as Jack said, I'm sitting at my desk, and Rob and I were traveling all over the world with his job, and I was pretty happy, and across my desk comes this amazing job that has California earthquake mitigation and single-family homes in it. And I thought, this is really exciting to me. This is really something that I'd like to participate in. And so the Chief Mitigation Officer, like the CEA, was created by statute. And in September of 2010, the governor signed into law AB 2746, creating my position. So I always say that it took a state law in order to get me out of kind of semi-retirement. And really important things in this statute was what the Chief Mitigation Officer was going to be doing, was to manage this mitigation program, and importantly, to also be in conformance with the Fair Political Practices Commission. So I do file the financial interest form at the end of the year, which is very much like a state agency as well. That comes back to that publicly facing work that we're doing. And then, very importantly, the mitigation charge started in 1996, but was clarified in 2010 to be able to accept grants and gifts. And so it was very important that the people that were at the CEA, that created the CEA, understood that this mitigation program really needed to be able to accept funding into the Loss Mitigation Fund in order to do the good work. Now, my insurance colleagues would laugh at me, but when I started, I had to open up Investopedia all the time because I wasn't fluent in insurance. And so I always tell people that the way I look at insurance is you're sitting around the family table at Thanksgiving, and somebody says, you know, we just should start our own health insurance group. You know, not really thinking that when you jump into an insurance pool, you jump into a pool with the folks that are in it. And so immediately she says, well, that'd be great. I need a new hip. And someone else says, well, I'm a teenager. I'm healthy. Why would I need insurance? And, you know, besides, I need to put that money into my gasoline for my new motorcycle. You know, obviously, having a teenager in your risk pool would increase your risk significantly. And then, you know, a child, you know, is saying, okay, you guys want me in the pool because I'm healthy. But then I've got Uncle, you know, John over here who smokes and, you know, smokes like a, what is it, chimney, and drinks like a fish. And all he's thinking is, do I tell him about my liver? And, you know, what about Jill's husband? We don't know a lot about him. We don't know his family, you know, health history. Are we going to be able to get a dossier on his health history? And then, you know, Uncle John is still worried about what he's consuming. So the idea here is that, you know, an insurance pool is, you know, as we've all been hearing for months and months and months, you know, trying to get the healthy in with the sick. And maybe starting out when you're healthy, knowing full well that eventually you may join the population of those sick. And but there's a difference between what's property and casualty and health insurance. And for one thing is that there's lots of data about health insurance. You know, we know a lot about, pick someone in the room here who's young, you know, a 21-year-old male who you know, grew up in California, who, you know, whose family history is such. We know a great deal. We know about the insured, you know, we know their gender, their ethnic background, their age, their income, their behaviors, their environment, all of which would be used actuarially to figure out what the expected risk is from that individual. And it's a little bit different about California dwellings. And one of the reasons is that, as I mentioned, we are one step removed from the participating insurer. And so the information that we get really comes from a fire and other type of insurance perspective. And they're giving us the things that they know about the building. They're giving us the year of construction, the number of stories, the foundation type, the replacement cost, whether it was retrofitted, if that's applicable, and their coverage choices. So it's pretty limited, the information that we're getting about a house. And one of the reasons is that it costs money to go out to an individual house and to figure out exactly what its expected health is. You know, whereas a lot of people are going to be going to a doctor every year. You know, not a lot of homeowners have their own special private structural engineer who's helping them determine what their house is. And the idea is that that's expensive. That's an expensive service to pay. So we have some broad information, and we're occasionally pushing a little bit to get more information, but it's not exactly detailed. So we've had some opportunities recently to kind of look into what's happened in earthquakes. Northridge, we had a lot of data, but imagine 1994, all in boxes and file folders, not digitized. The reality is that if there's no significant structural damage, a claims adjuster is not likely to have climbed under the house to see if it was retrofitted. So once again, it's really kind of basic information. And so we thought, well, here's the Napa earthquake, magnitude 6.0 in August of 2014. Magnitude 6 is a moderate earthquake, but there were in fact areas of Napa that had some strong shaking. Let's do a survey. Let's see what we can find out. And this is where it was very exciting to me to work with, the social science side of the house, how you ask questions, how you create a survey, how you get information that you can use to move on. And it was interesting that most of the interviewed homeowners in Napa grew up in California or had moved here decades ago. They showed a very high awareness of earthquakes, which is really interesting. Now, Napa had an earthquake in 2000. It was really up in Yountville, but it was enough shaking that they certainly saw damage. So they had a knowledge of earthquakes and other natural hazard risks of home ownership. Dr. Cheryl Rabinovich, a PhD from Berkeley, helped us by doing an online sample from, I think, over 600 respondents, where we asked very basic questions. And then she went back to just under 50 and did actually personal interviews with each of the homeowners. And found some really interesting things that actually, when I look back at what I learned in those 18 months after the Northridge earthquake, really reinforced that people can become very deeply attached and emotionally invested in their homes. And particularly those with historic homes, people who have spent a long time kind of bringing the quality of that home up. They expressed a high degree of personal connection to their property, sometimes including thousands of dollars and years of investment, as I said, in historic restoration, and had a desire to continue to live there. These were not people who were going to throw up their hands and say, okay, I've had it with this earthquake risk. They were in it for the long haul. We asked them about retrofit, particularly older homes that perhaps needed retrofit. And a high percentage of people who owned retrofitted houses, frankly, it was a little disappointing, didn't really understand what that meant. Like, for example, they may have attached their chimney to the house and mitigated perhaps one particular kind of vulnerability and then thought the whole house was retrofitted. So attached the chimney and was surprised the house slid off the foundation, or strapped the water heater and then was surprised that there was damage to the roof. And so they knew that there had been some retrofit done, but really couldn't make the connection to what that retrofit did in terms of reducing damage, or perhaps failed at. So that was really interesting and very important to someone who's managing retrofit programs. With insurance, they had a high awareness of the existence of earthquake insurance, but a low level of knowledge about the specifics, including recently made available insurance options. So we actually, 2014 earthquake, this was 2016, we had introduced with a marketing campaign all of those choices that I was talking about. In 2016, that created that huge bump, but the people in Napa, we didn't find a lot of people who had a lot of awareness of that. And so the study reinforced that we need to have clear and consistent access to information about earthquake mitigation and insurance. And that consistency we've heard over and over from social scientists. And we know this. It's like, the health campaign that don't eat eggs. And then it seemed like 2 years later, you should eat lots of eggs. And then there was another year, don't eat eggs again. And you're going up and down. And granted, there may be studies that come out that are changing that. But the perception to the public is that scientists don't know what they're doing when we don't have consistent messages. Now, it's really kind of fun to be involved in a political arena that I had not operated in as a consultant. And I kind of figured one day, I'm in a special interest group. I always hear that in the negative when you hear about that, a special interest group. But definition one is a group of people that are receiving special advantages, which I thought was an interesting word, or they're a group that's seeking to influence. And so the key words here, special advantages and narrowly defined interests. So this is all kind of has a tone of negative, but when you think about it, the special advantages that the CEA on behalf of California homeowners are looking for are seismic tax exemptions or incentives for retrofitting. And so here's, maybe a little bit of a turn on the word special interest. This is a group that's looking out after the interests of California homeowners and trying to reduce their earthquake risk. And that narrowly defined interest, well, there's a perception that this is a California problem, and we do have 2/3 of the earthquake risk in the nation. But the reality is that Oregon and Washington have the Cascadia earthquake zone. Utah has a significant earthquake problem. Oklahoma now, thanks to wastewater injection from fracking. New Madrid zone had the largest earthquakes in the contiguous 48 states. Charleston, the Boston area. I mean, when you look at a map of earthquake risk, the reality is that there's quite a bit of the country has earthquake risk. And so the idea is that this special interest group that's perceived as a California problem really should be perceived as something that's larger. And I wanted to just clarify for you that the way that I'm looking at risk is that it's hazard and vulnerability. Where hazard is location, your proximity to a fault, the kind of soil that you're on, location, 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 and vulnerability is structure. Of course, with different structures having different vulnerabilities. And then you add to that kind of what we understand about the risk in California and who might be interested in being advocates for our message, our special interest message. And one of the interesting things that you look at is if you see all the faults, they kind of run along the San Andreas fault zone along the coast. Well, when you're looking for political action on some of the issues that we're looking at, and you overlay that with the areas that are Democratic and Republican, you'll notice that only Democrats apparently live in high seismic zones. Or that's what it kind of looks like. The reality, of course, is that that's where the majority of the population in the state is. But when you're looking to introduce a bill at the state, or this is the federal map actually, at the federal level, and you need bipartisan support, it is a little difficult that so much of the risk is in Democratic areas. And then just showing you very clearly, there's that San Andreas fault overlaid with the political representation. So the San Andreas Fault, as I mentioned, runs down through California, and there are in fact areas where it's very plain to see, and they are in rural areas. But the reality is it runs through the Los Angeles, just east of the Los Angeles area, and then smack dab through the San Francisco Bay Area. And then you can see very clearly from the air, maybe a little more difficult in times before we were up in space and up in planes, but very clearly geographic features that show you where the fault is. Well, those geographic features are actually quite lovely and actually very important in terms of where we first inhabited California, right? Because it's going to be, you want to have a port. You need to have the quiet waters of the bay. And in Los Angeles, you had the mountains behind the plains. You had lots of, believe it or not, in Los Angeles, for the small community that first moved there, lots of water. And so all of these, one of the reasons that our population, of course, lives near the coast is because of both the geographic features and the proximity to the shipping that the Pacific Ocean entails. So there's our population. There's our democratic presence in a political world that really needs to be bipartisan. So where do we stand with the CEA? We're a financial institution, a little unique financial institution, as I mentioned. So how are financial institutions capable of being resiliency drivers? Resiliency being the ability to bounce back from a natural disaster like an earthquake. So let's start with flood insurance. Surprised to hear 12% of homes in the US have flood insurance. And flood insurance is mandatory in high-risk flood areas for all federal or federally related financial assistance. So the reality is that in a high-risk area, if you don't have a mortgage, you don't have to have flood insurance. It's really only when you have that connection to a federally backed mortgage. Lenders may require flood insurance in areas of moderate to low flood hazard. And the National Flood Insurance Program that would provide this flood insurance is managed by FEMA. Premiums, like an earthquake insurance, can be reduced by mitigation. And so you're walking down Stinson Beach and all the houses are down at grade, and all of a sudden, whoop, there's a house that's up on stilts. That house is clearly paying for flood insurance and is probably paying a lot less than their neighbors because they have elevated that first floor probably to a foot above the expected flood level. So financial institutions, lending institutions. I remember, for decades as a consulting engineer, I thought, why is it that banks and insurance companies are not requiring mitigation? Why aren't they our partners in encouraging and promoting mitigation? Well, the reality is that it's a fantastic opportunity in California. 47,000 homes sold in California each month. You can imagine at every transaction, if there's professionals who are encouraging you to insure your home and to mitigate your home. But the reality is that those are transactional relationships, and that's not a criticism. I'm a capitalist from day one, but they're transactional, which can be very transitory. Local banks may sell and service the loan, but most mortgages are bundled and sold off, which is that mortgage-backed security. And so the reality is that you may insure your home, you may get a mortgage from Wells Fargo tomorrow. It's very likely that within a few short days that's been bundled off and sold. And so the relationship with that lender is one where they're servicing your loan, but they don't own it anymore. And many of those mortgage-backed securities are now really owned by Fannie Mae and Freddie Mac. And they are not currently requiring earthquake insurance. They're back in Washington, D.C., and have not shown any indication that they'll be doing that anytime soon. Now, lending institutions, why isn't there a law? How many times have you heard yourself say that or heard someone else say it? There should be a law. Well, there is a law in California that if you're selling a home that was constructed before 1960, you need to give this booklet and that form to the buyer. And what it is it's information about the hazards in California, and you might have vulnerabilities and you should do something about it. And there's even a form that says, is your house bolted to the foundation? Do you have plywood on your cripple walls? Have you braced your water heater? But you are allowed to put, you don't know. And so apparently in the 90s there was legislation that was going to give this a little bit more teeth. That was vetoed by the governor at the time. So, and you can understand why. I mean, this is very controversial. This, in terms of a transactional experience, this puts a significant wrinkle into a sale. And the other thing about this particular form that's important is, despite the fact that there is this information being given to buyers, my understanding is that these are really being handed to the buyer at the title company after you've already agreed to buy it, and you're literally sitting there with a stack of information this tall, and you're just signing on one. If you haven't bought a house, it's embarrassing to admit that we've done this. Where they give you a stack and they go, "This is the blah 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 blah," and you sign, and so there's not a lot of teeth in this, not a lot of teeth at all. Now, earthquake insurance. We're the experts. We're the guys. We should be able to have a lot of influence, and I think that we do. But it's a voluntary market. And only 10% of Californians have earthquake insurance. And so our sphere of influence is actually very small. We can offer all kinds of different things, but the group that we're offering them to, they're the choir. We're preaching to the choir. They understand their hazard. They understand their vulnerabilities. And, they're in. The other 90% we're working on. So what are we doing about all this? Insurance premiums, first of all, a little bit more information. Insurance premiums are based on location, the hazard. Okay, so I live right next to the Hayward Fault. Our premium is going to be more than somebody who lives out in Tracy. Some damage indicators like the age of the home, the number of stories, foundation types, that list that I told you that we know about houses. The premiums reflect mitigation efforts. We have up to 20% discount if you've retrofitted a certain kind of vulnerability. And earthquake insurance, it's important to note, is not backed by the federal government. So it's not a federal or state program. So just some important things that kind of set up for the sphere of influence that we might have. And as I said, here's a perfect opportunity to introduce lots of professionals who could be giving information to home buyers, from the real estate agent to the mortgage, to the lender, to the insurance agents who's stepping in, to a contractor, a home inspector. A number of touch points here, and frankly, we're missing out on some of those. So what is the CEA doing in our little narrow 10% sphere of influence that I'm really excited to say is growing? We have a mitigation incentive program called Earthquake Brace and Bolt. It's managed through a separate entity called the California Residential Mitigation Program that is jointly managed by the CEA and the state's FEMA, that's Cal OES. So we have another entity and a separate board. We're managing this incentive program. And we provide up to $3,000 for seismic retrofits. Now the retrofit that we're providing this money for is on average is about a $5,000 retrofit. So you can see it's a really, really good incentive. And this is exciting because this is the part of the house that is for all Californians. And I have, I wondered if anybody lived in the Bay Area in a house that was constructed before 1979 who might have this problem. You're welcome to take one of these. It's about the program. Because sign-ups will be in January. You might have a parent, you might have an aunt, an uncle, or you might be just interested in what a mitigation program is like. And we provide up to $3,000, and we are in our 5th year, and we're going to be doing 2,000 homes this year and 2,000 homes next year. Little drop in the bucket. We figure that homes that need this bracing and bolting, there's probably 1.2 million of them in the state of California. So what are we retrofitting against? We're retrofitting to reduce this kind of damage. And so this is the kind of damage that you get in a house that was constructed before seismic codes were readily adopted throughout the state of California. This is an older home, probably constructed in the 1910s in Napa, so magnitude 6 earthquake. These little studs that go around the crawl space under the home are called cripple walls. That's an old term from construction, probably not politically correct. And the houses have a tendency, they don't have anchor bolts, and so they have a tendency to slide or topple off of their foundation. Very costly damage. It can cost tens of thousands of dollars just to shore the home to rebuild the foundation if the house hasn't racked too badly so that it's a total loss. This is the kind of retrofit that we're doing. So here is an example under a crawl space, a little taller crawl space here, and I like it because it's painted white so it really can show those studs. All it has is the original finishes around the outside that don't provide any stiffness. And the retrofit is to put anchor bolts along the mud sill. So you're anchoring this flat piece of wood to the concrete, and then you're putting plywood on that cripple wall that goes around the crawl space. So you've attached the house so it won't slide off the foundation, and you've braced it or stiffened it so that it won't topple off the foundation. And then when you have a crawl space that's kind of short, you can come in from the side with these foundation plates. And as I said, it's about a $5,000 retrofit. Really an amazing cost benefit when you consider the tens to hundreds of thousands of dollars we're talking about for that kind of damage we saw in Napa. Now remember that the homeowner who was in that house, and in Napa fewer than 6% were insured, and so that person had to find a place for their family to live and find the financing to, as I said, shore that house or sell it, all the while still paying your mortgage. So the banks don't step in and give you a pass when you have earthquake damage. You're still responsible for that mortgage. And so this is an amazing cost-benefit retrofit for that kind of damage. Now what we're promoting is a code-compliant retrofit. And this is really important because for many, many decades, there's been a movement to retrofit these homes, but unfortunately there hasn't been a code. And so it really was what the contractor came in and recommended that you do. And some of them really did their homework, worked with structural engineers, and were doing quality retrofits. Some were not. And I think ABAG, the Association of Bay Area Governments, did a study back in the early 2000s and found that 80% of the retrofits had not been done correctly. It doesn't mean that they were a total failure. Maybe you had half as many bolts as you needed. But the reality is that there was definitely some room for improvement. And so these plan sets developed that could be used for voluntary retrofits. So no one is requiring that the homeowner retrofit. It's a voluntary retrofit. But you want to give them a standard so that when they ask a contractor to do the work, the contractor knows that he starts at A and he goes to Z. He doesn't get to just make up stuff in between. And then in 2010, we actually were instrumental in having the state adopt Chapter A3, which is a code that goes with the plan sets. So we now have an adopted code and we have some plan sets. Plan sets are just pre-engineered retrofits that can be used by contractors or or homeowners without an engineer. So if I want to get an engineer in to design my retrofit, I'm going to put all of us out of business here. It's a couple $1,000s or maybe $1,500 for a very small house. And this for a very simple retrofit now, you can have this pre-engineered plan set that a homeowner or a contractor can use, significantly reducing the cost. So back to our representatives and how we can get representation, we can get that, our special interest group can get the ears. I think we all know that we have Senator Feinstein, Kamala Harris, and our Congress member for Berkeley, and I picked right here, have been tremendously supportive. Once again, they recognize that if they introduce something that it needs to be bipartisan. We may hear about the dissent in Washington, and I think it certainly exists, but the reality is that they certainly know for anything that we would be introducing as a bill, you need to have bipartisan support, and they've been very supportive. They have unlimited 6-year terms at the Senate level and an unlimited 2-year term. These are relationships like any relationship that you have in life. When you're trying to take your special interest group that has something that you need assistance with at the federal level, you know, Feinstein's been there forever, Kamala Harris is new, Barbara Lee's been there forever, but you know, a lot of districts, that 2-year term is troubling because you might have a fantastic relationship with a Congress member who then is not elected and you start over from scratch. And so the relationship part of it is very, very important. In addition, what's very, very important is the committees, the seniority of the member can be very, very helpful. Obviously, Feinstein, having been there as long as she has more clout than Kamala Harris. And what we heard when we were in DC was a lot of people saying that they think the reason that Feinstein is running again is that Kamala Harris doesn't have enough clout for the state of California yet. And then when we need to do something at the California level, it's even more difficult to have long-term relationships. These are, once again, the state senator and the assembly member for Berkeley, and they have 2-year terms. And they are constantly campaigning. And that's not a criticism of them, that's the reality. When you have a 2-year term, you're barely elected when you have to start looking for, you have to keep that support going. And the other thing that happens with this that I've learned is that they need to have bills that aren't, you know, long-term bills are difficult for them to propose because they don't see and they can't show their constituents that they've made progress, you know, in the short time. Now, we do have a very important bill at the federal level that's been introduced, and it's the Earthquake Mitigation Incentive and Tax Parity Act of 2017. What this is that $3,000 grant that we're giving to homeowners is currently not taxable at the state level, but is taxable at the federal level, which is a tremendous disincentive to encourage. And so we do have Congressman Mike Thompson from the Napa area, and you'll remember Napa not only had the 2014 earthquake, but suffered from that 2000 earthquake in Yountville. That's his district. Co-sponsor, Paul Cook. Paul Cook is down from the kind of Inland Empire area, had 3 very devastating earthquakes in series in the 90s, and so he certainly is old enough to understand how important it is to his district. And then another Congressman, Pete Aguilar, who has stepped in to assist in his district, is down there as well in that area. So understand what the risk is, understand that this is California's problem, and you know, fantastic bipartisan support for that Tax Parity Act. It's a small bill, so what I understand is it's likely to not be passed on its own, but rather to be attached to something. And so it's kind of an interesting place to be, to think that it might be attached to a, let's say, a tax bill that might be going through Congress soon. So what else are we doing? We recognize that to have codes and standards for people to use to retrofit, that we were really missing a lot of them. And so we're working with the Applied Technology Council to develop additional plan sets for different kinds of vulnerabilities, living space over garage, that single family soft story condition, hillside homes. The ATC 110 project is interesting in that we're developing these pre-engineered plan sets that are for really, you know, and this is not a criticism of the industry, this is the vernacular architecture. The idea here is that our construction for homes needs to be cost effective. And so it's really not very high tech, what we're doing to build homes. So we're balancing this very sophisticated engineering analysis with the vernacular construction, which is very interesting. And we're encouraging voluntary retrofit to a code standard by creating the code, as well as providing alternate solutions for hard-to-reach communities. We recognize that that $3,000 may not be sufficient for economically disadvantaged communities, so we're looking for other opportunities. We developed something called QuakeGrade, which took a FEMA product that was something that you would fill out with pen and ink. Home inspectors who go out at the time of purchase fill something out that grades the house for its expected performance in an earthquake. We took this pencil and paper and turned it into an app, which is an interactive web experience. And we are training home inspectors to use it, working with the organizations that manage home inspectors in California. They'll be taking over the training, and the idea is that someone will say, I'd like to get an understanding of what the performance is on this house I'm buying, and they could go to the website and they could look up a list of a trained home inspector who's using our product. And we'd like to work with the California real estate professionals, because the reality is when you buy a house, the person who recommends a home inspector to you is your realtor. And so we're looking for stronger relationships there. We're developing a document that can be used by those claims adjusters for those participating insurers when they come out to your house when you make a claim after an earthquake. The idea is to standardize the process of doing a claims adjustment on your home, and also a supplemental engineering document. And then, very exciting, we're working right here at UC Berkeley with Peer on an exciting research project. So you have that cripple wall house that we've retrofitted, right? And you have the cripple wall house that isn't retrofitted. Just how much have we changed, have we tilted the scale? What is the homeowner going to get in terms of a cost-benefit analysis for having done that retrofit? The reality is we've never done this research. We don't know what that number is. And it's a very important number, first of all, to convince you to retrofit your own, but also to quantify the reduction in damage so that an earthquake insurance company like we are can give you a really meaningful mitigation discount. So, natural disaster resiliency, throw in a little humor here. We can't really change the size of the punch, but we could certainly increase the likelihood that it'll be a glancing blow rather than a knockout. And this is what we're doing, is we're wrapping that house with bubble wrap, not exactly bubble wrap. This is a picture, of course, when we're talking about resiliency, we're talking about protecting a community from earthquake damage. Those of us who spent many, many months after Loma Prieta and Northridge, and we've seen in San Simeon earthquake and Napa earthquake, we recognize that an earthquake doesn't just damage structures. It can damage the fabric of a community. When you think about the beautiful homes, the Julia Morgan and Maybeck homes in the community, we saw this in the fire in 1991. You really see what an earthquake can do to a community. And more than half of our residents in the Bay Area are renters. And those are people who will pick up and leave, and they'll go find another place to live. And so we're protecting more than the structures. We're protecting the community itself. And that's really what resiliency is. And so it's very, very exciting to be part of this organization. As I said, I've had to create a whole new library of books to understand the various different types of consultants who we're working with. But it's a really exciting place to be. I think we're making a difference. I always say we're making the Bay Area resilient, one house at a time. And I'd like to thank you. And I don't know how much I've left for questions? Nothing? I'll be out there too, so you can. Okay, so -1 minute of questions. But I get 9 minutes of credit, right, for the beginning?
At least 9 minutes.
Thank you. Thank you. Any questions? Yes.
Thank you very much. This is very informative. Maybe I should go by earthquake. But my question is, instead of preparing for the big punch, would CEE have interest in predicting when the punch is going to happen, whether it's early warning and then avoiding it, or health monitoring, or sensors, or big data, or sort of things?
We do. We've supported the USERF and NGA West projects, Uniform California Earthquake Rupture Forecast. So it's the forecasting of the expected probability of a particular sized earthquake on a certain fault. We've sponsored that kind of science because that very definitely goes into the model that we use to fund our, to determine rates and premiums. What's really important to understand is, you know that tower that said we need $15 billion? The state of California didn't tell us we needed $15 billion. We didn't come up with that. You know, the reality is that it's the rating agencies that you know, approve that, and that rating agency's rating, A-, is very important to getting the reinsurance at a decent cost. And so, you know, the financial is interwoven with that level of risk. I will tell you that I don't think the average person who buys earthquake insurance understands what level of earthquake. They don't understand that the insurance is covering a 1 in 400 year event. You hear a lot, I don't think I'll ever see, you know, that anything over 15%. And you know what the reality is? I hope I never have to use my health insurance either. But the reality is that somewhere, 99% chance of a magnitude 6.7 or greater in the next 30 years in California. And so when I look at it, you know, on behalf of California, you know, the idea is I can't tell you exactly you're going to get it and you're going to be fine. And so the idea is we have to float all boats.
Thank you.
Another question?
So, like, since CEA is a privately funded and publicly managed organization, do the insurance companies have to provide you information about the number of policies, the limits, deductibles, and the number of claims to you? And do you have to provide that information to public? Is it required?
So, so the reality is that the insurance companies are businesses, and so there's a certain level, there's quite a bit actually, a level of privacy to the information. And when they share information with us, we are very careful about that information. I'm trying to catch where you're coming from. So they give us, when someone buys a policy, they give us the information that we need. That it, you know, all those things. It's the age of the house, the number of stories, and they have figured out the replacement cost, and so that is where the premium comes from. So a lot of the information does come from those participating insurers. Did I answer?
Yeah.
Okay.
Any other questions? I have a question about your underlying science for determining what my policy rates are. So if I decide to spend $1,000 on bolting my foundation, I mean, does that $1,000 really get reflected in my policy?
Right. So currently, on an older home, you would get a 20% off of your premium. But PEER, I'm looking at Grace Kang here, this research program is a 3-year research program. We really do expect that the science that we're doing with that program will show us that it can be significantly higher than 20%. I'm not predicting that. We expect that it will be more than 20%. The indication would be that it would be more than that.
So there's some calculus that I would be better off getting insurance or fixing my house?
I would say that you should do both. I mean, when you think about it, the nice thing now is that, and I didn't show the slide, we now have deductibles from 5% to 25%. And so 25% might be the perfect deductible for, you know, let's say someone early in their careers who's just bought a house, who wants to have that catastrophic coverage, but will, you know, can't pay as much. Whereas if you're, you know, in your 60s, gee, who's that? Living near the Hayward Fault, looking around the corner, and retirement isn't that far off, that 5% is actually is starting to look like a deal. Because, you know, the amount of time that I'm going to own that home, the reality is that, you know, maybe the probability of an earthquake is very low, but that is the single largest purchase I'll make, and so much of the equity in that home is part of my retirement. And so by providing more choices, as you can see if you go on and play with that premium calculator, we've really allowed people at different stages in their life, different financial situations to hone in on what they need. And so what I say is you want to retrofit the known vulnerabilities, and I showed you 3 of the top ones there, and then insure for the unknowns. And that really is the way insurance should work. And that's why we're working so hard to mitigate as many homes as we possibly can.
Okay. Did I see a final question? Okay. So Professor Harley, what do you think? Should we adjourn to the refreshments? All right. Thanks, Janiele.
Thank you.